So I just want to show you a couple of benchmark transactions that we've done. The reason I'm showing you these transactions is because they sort of have a story. This is a building that we tried to sell in 2008. We had a good offer on it, and then when the recession hit, you know, all the buyers sort of just put their pens down. Well, when the recession was over, you know, as much as we can define that, the end of 2009, beginning of 2010, the same buyer came back and he bought the building at the same price. And this building is in Scarborough. It was sort of a deal that I would refer to as the buyer bought it by the pound. He paid $70,000, you know, per unit, but the building was condo titled, and the building sold at a 4.5 cap rate. That shouldn't have been. I mean, if this were a non-condo building at that time, it probably would have sold at about a 6 cap rate. And the point that I want to make here is that a condo titled building has significantly increased value, and this buyer bought it, was a syndicator, and he's selling off the units one by one. So he bought the building at $70,000 per unit, and he's retailing them out at well over $100,000 per unit. So there's definitely a value in condo titling, and it's hard to do in Toronto, or virtually impossible to do in Toronto, but outside of Toronto, it's possible to do. So you're doing it for two reasons: getting a better tax rate, but also having that ability then to sell off the units one by one. This was the deal. This was a large deal. This was a $215 million deal, the Cherry Hill transaction in London, Ontario, and this was 2,300 apartments and a shopping mall and a small medical office building. So we took this out to the marketplace. It was difficult to know how to price it. We listed it, but we took it out unpriced. It wound up selling for $215 million. And so sort of the lesson that I learned on this was, and the question that I was asking myself and asked many people, because there are 2,300 units in London, is that a premium or is that a discount? Well, I'm still not sure I know the answer, but let me talk about this from a theoretical standpoint. If you have 10 100-unit buildings in Toronto and you've assembled those over the years, I would argue that 1,000 units, the 10 buildings, would sell for a premium, okay, as opposed to breaking them up and selling them individually, because it would take someone years and years to assemble 10 apartment buildings, you know, into a portfolio, so they would probably pay some kind of a premium, or at least that's the way the theory goes, right? Now, if you had 100 units and they were 10 10-unit buildings, then the question becomes, is there a portfolio value there? Because you've taken the time to assemble those 10 10-unit buildings. There I would answer, probably not. You'd be better off selling the buildings individually. Because what we found is that, and as the unit count goes lower, people pay less and less attention to cap rate. So when someone's buying a 10-unit building, they might buy it at a cap rate that you would never buy a 100-unit building at, because they just want to own one small apartment building, and it's the cottage investor, the hobbyist, or the small investor doing it. So on this deal in London, you know, as the broker on the deal, I was thinking that, you know, there should be a cap rate premium for this thing. It should go to a lower cap rate because, you know, it's taken, you know, 25 years to build these many apartments all in one location. And what we found was that most of the buyers, and we had a number of buyers too, you know, who looked at this, didn't really give it a big premium, because it was all in one spot and it was all in London. So I guess the thing I learned from this was that if there is a very large concentration of apartments in one location, that maybe adds some risk to the deal. The end buyer was Minto. Minto was the lead on it, but they took in two partners, KingSet Capital and Hoop. And I think the idea was you had 23 apartments in London on one corner was a big bet. It was a beautiful asset, something that you could, you know, buy and own for forever. But nobody wanted to take that risk of buying 2,300 apartments in one city and all in one corner. So most of the offers that we got were people who were looking to syndicate it. The next slide is a number of deals that we've done. All of these have been new apartment construction deals, and most of these were market maker prices. The building in the top left-hand corner was a building in Ottawa, and it sold for $280,000 per unit. I think $390 per square foot. I think that was pretty close to a record price in Ottawa, and it was bought by a private individual. The building just below it is a building in London, Ontario, and that sold for $240,000 per unit. Again, that was a record price. So I don't think a lot of new buildings have sold in Canada in the last 10 years, but in the last year, we've been able to do 6 new construction deals. And I think people are starting to recognize that, when you buy a 30, 40-year-old apartment building, yeah, you might be buying it at a 6 cap when you could buy this building at a 5.5 cap rate, which is more expensive. But, if you look at it over the long run, this is a brand new building. It's brochure quality. It's going to require no capital expenditure work for 10 years. If you buy a 30, 40, 50-year-old building, albeit at a higher cap rate, you've got your work to do and things like that. So I think institutions are starting to recognize, and I think that they want their apartment buildings to look like their office buildings. So we sold 6 new buildings, and we have some other buildings that we currently have under contract. And again, people are paying this price of north of $200,000 per unit more routinely now than let's say one or two years ago. So my guess here, and what I would expect to see, is that we're going to see more people building apartment buildings if they can get this mid-5 or low-5 cap rate, especially if interest rates stay low. Now, in terms of, I want to talk about apartment acquisition strategies. There are many investors on the phone, there are many brokers on the phone. So typically, I would say this is a high-demand, low-supply business. That's the way you define the apartment sector. They're pretty much always more buyers than there are sellers. And so what we say to our clients who are buying is, and I want to lead here into a discussion on a topic we call buy-side brokerage. About half our deals that we've done are buy-side brokerage, where we're working for the buyer. And so what we say to them is, look, the first thing you need to do is you need to identify the missing niche in the marketplace, or something that makes sense to you. So, some people just like student housing, some people just like townhouses, whatever it is, focus in on a certain type of asset and let us identify that. Choose the area you like, and then let's look at something that's scalable, and then we'll go out there and we'll buy apartments. We'll buy apartments for you, right? So if you take any city in Canada, I think it's fair to say that if you look around hard enough, you're going to find some stagnant portfolios. People who've owned the buildings for a long time, they're just not running them efficiently. You'll find repositioning opportunities. So you'll find buildings in good locations, in transit-oriented areas where there's good employment, and the buildings have just gotten older. The incomes of the people are high, and we're seeing a lot of people now, with prices being the way they are, it's pretty hard to buy a 40-year-old building at a 5.5 cap rate and have it make sense. So you've got to go in and you've got to turn that building around and reposition it. And we've seen people reposition buildings pretty dramatically and raise the rents, $300, $400, $500 after renovating the apartment. So we think that for the hands-on operator, buying a stagnant portfolio or buying rundown buildings in good areas certainly is a good option. The only downside to this option is that you wind up staying in the deal for a very long time. You can't buy a 40-year-old building and then go in and renovate all the units. You've got to wait for the people to turn over. And as we know that, the turnover rate in an apartment building is around, 30% a year on average in the country. But that doesn't mean in 3 years the building's going to turn over. It would probably be better said that in an apartment building, 50% of the residents stay put, and the other 50% turn over at 60% a year, but the average turnover works out to be, around 30 or 35%. So it can take a long time to wait for residents to move to turn an apartment building around. There's another category I call sort of empire loyalist buildings. They're often, well-located buildings, have a very high percentage of seniors living there. The owner is just kind of happy with the full building. He doesn't have a mortgage on the property. A new buyer can come in and manage the building more effectively, renovate the building, and raise the rents. And then in every town there's some story buildings. Buildings have a story behind them. There's some opportunity there, and things like that. So we work with clients who can clearly identify a niche. So, for example, if one client came to us and said, we want to buy apartment buildings near universities. So they were interested in student housing. So we said, great. We drew a 1-kilometer circle around the university. We identified all the apartments there, and then we went representing the buyer to meet people, to meet the owners of these buildings, and to put in offers on the buildings. So at this point, I'm just going to show you another video now on the topic of buy-side brokerage.